The current live trading price for SoFi Technologies Inc., NASDAQ, SOFI, is $28.07 USD, reflecting an intraday movement of plus $0.20 or plus 0.72% as of 1:04 p.m. GMT-4 on October 15, 2025. Now, most investors looking at SoFi today are fixated on the upcoming Q3 earnings report on October 28th, just under 2 weeks away, and they're primarily looking for one thing, a beat on the consensus EPS of $0.08 to confirm the profitability narrative. But here is the deeper angle to consider. The market is dramatically underestimating the quiet but highly significant shift in the quality of SoFi's overall product mix, a shift that is insulating their business against the very interest rate volatility that is crushing other fintech lenders. And this is the factor that will truly surprise people, not just the headline earnings number. The popular expectation is that SoFi is a volatile, high-growth tech lender whose fortunes are tied primarily to the student loan and personal loan markets, making it a proxy bet on interest rate cuts. The stock's dramatic rally, it has been up over 200% from its 52-week lows of $8.62 to near its $30.30 high, has been fueled by this simple narrative of rate cuts and its relatively recent achievement of quarterly GAAP net income. This perception, while partly true, misses the core development, the substantial and accelerating growth of its technology platform and financial services segments, which generate high-margin, fee-based revenue, as opposed to the more capital-intensive, interest rate-sensitive lending segment. While lending still drives a large part of the top line, the real fundamental change is the soaring contribution from non-lending sources. In the second quarter of 2025, for example, the company reported adjusted net revenue growth of 44% year over year, and crucially, fee-based revenue growth of 72%. That is a massive difference, and it fundamentally changes the structure of the business. The market sees a lender, the reality is an evolving financial technology infrastructure powerhouse that also happens to have a bank charter. And the key to understanding the next 10 days of stock movement is realizing that this fundamental reality is what is setting the floor for the stock's pre-earnings consolidation. The stock's daily movement today, showing a modest climb despite a drop from its intraday high of $29.09, demonstrates this tension perfectly. Traders are weighing the recent good news, such as the initial rollout of Options Level 1 trading for its invest members, a move specifically designed to deepen engagement and increase fee revenue within the financial services segment, against the general macroeconomic jitters. The trading volume today is relatively light compared to the average, which suggests that the market is in a holding pattern, with conviction buyers waiting for the earnings print and short-term traders taking profits around the $28-29 level. The 52-week high of $30.30 acts as a psychological ceiling right now. The recent analyst action shows this internal conflict clearly. You have new reports coming out, like a Keefe Bruyette analyst recently raising the price target but maintaining an underperform rating, while others, like Mizuho, remain outperform with a significantly higher target of $31. The median analyst target price is around $22.08, which based on the current trading price implies a significant downside, suggesting that analysts' traditional valuation models are struggling to keep up with the stock's growth rate and the new component of its banking business. This gap between the conservative street price targets and the current stock price is the main source of volatility and disagreement on the message boards right now. Looking at the immediate past, the stock has been a stellar performer this year, rallying 70% year to date. Much of this appreciation reflects the successful execution on CEO Anthony Noto's stated goal of achieving consistent GAAP profitability. When a growth company crosses that threshold and proves it can generate net income, it moves from being an academic exercise for investors to a viable investable business model. The Q2 2025 report confirmed this, showcasing a record 850,000 new members and 1.26 million new products added, driving membership up to 11.7 million. This relentless cross-selling of products, from lending to banking to investing, is the core strategy. Every time a member adds a product, the company gains a new, sticky, high lifetime value customer, which is where the long-term value lies. The recent Options Level 1 launch is a perfect example of this expansion, drawing more sophisticated users to the investment platform and increasing transactional revenue. The operational foundation of SoFi is built on 3 pillars: the lending segment, which includes personal, student, and home loans; the technology platform, which is Galileo, providing core processing infrastructure for other financial services companies, a high-growth, capital-light business; and the financial services segment, encompassing their banking, investing, credit card, and insurance products. The bank charter secured in 2022 was a significant accelerant, allowing the company to fund its loans with low-cost member deposits rather than relying on more expensive wholesale funding markets. This not only improved net interest margin, but also made the lending business less susceptible to external interest rate hikes, a key competitive advantage over non-bank fintechs. As we look at the next 10 days, the entire focus shifts to pre-earnings positioning. The period between now and the October 28th earnings call is a period of high expectation management. The biggest immediate risk is not a company-specific event, but an external macroeconomic headline that causes a market-wide risk-off rotation. High beta growth stocks like SoFi are sensitive to these shifts. For instance, any unexpected spike in inflation data or a hawkish comment from a Federal Reserve official about maintaining higher for longer interest rates could quickly erode the enthusiasm in the lending sector and drag the stock back toward the mid-$25 range. The technical support levels are around the $26.50 to $27 range, corresponding roughly to the stock's open price today and last week's consolidation level. A sustained drop below that could trigger a deeper correction as stop-loss orders are hit. Conversely, the potential for upward pressure is rooted in option activity and favorable news flow. Unusual options activity in the run-up to earnings, as seen with some large call purchases recently, suggests that big institutional traders are betting on a positive surprise. The quiet whispers about potential government action regarding the sale of federal student loans to the private market, a development that would massively benefit SoFi's refinancing business, will continue to serve as a low-level positive catalyst. Even a rumor or a politician's comment about this topic in the next few days could easily send the stock towards or past its 52-week high of $30.30. The key to the next 10 days for SoFi Technologies Inc., SoFi, is that the price action is likely to be characterized by heightened volatility and whisper number anticipation ahead of the Q3 2025 earnings release on October 28th. We are already seeing the stock price trading far above the average analyst price target, indicating that the market is already pricing in a near-perfect report. The consensus EPS of $0.08 is the low bar expectation. The high expectation is a massive beat on member and product growth, which is the real metric of SoFi's long-term success. If the stock trades sideways, holding the $27 to $29 range, it shows a healthy consolidation of recent gains. A break above $29.50 in the next few trading sessions suggests momentum traders are entering for a pre-earnings run to test the $30.30 high. A significant technical rejection below $27, however, would signal a high degree of nervousness about the valuation being too stretched, potentially forcing a pullback, to fill the gap created by the recent rally. Investors will be scrutinizing any whispers on the street regarding member count and deposit growth because these are the operational metrics that validate the long-term bank plus fintech strategy. The forward-looking analysis continues to point to the company's growth forecasts, which are undeniably strong. Analysts forecast SoFi to grow earnings by over 22% per year and revenue by over 16% per year. This kind of aggressive growth projection is why the stock trades at a premium valuation compared to traditional banks and even some older fintech firms. The market is giving SoFi credit for its future potential, not just its current profit generation. The company's focus on the affluent but underserved younger demographic, offering them a one-stop shop for all their financial needs, provides a structural growth tailwind that few traditional financial institutions can match. However, the critical counterbalance is the relentless competition from giants like Apple, as well as established financial firms like Capital One and American Express, all of whom are also expanding their digital offerings. SoFi's challenge over the coming quarters, and what investors will be hyper-focused on in the Q3 report, is proving that its products and platform are sticky enough to retain customers even as the competition heats up. The recent insider selling, while not massive, also introduces a note of caution, with several executives selling shares in recent months. While these could be routine planned sales, in the short term they contribute to the narrative of an already highly valued stock. For anyone holding SoFi stock, the next 10 days are about managing risk and expectation volatility. If you are a long-term holder, the price noise in the next week and a half is likely just that, noise, as the fundamental story remains about member acquisition, cross-selling, and scaling the Galileo platform. For short-term traders, the setup is a classic run-up to earnings play where the probability of a sharp move in either direction is significant, especially given the stock's high short interest and dramatic year-to-date performance. The options chain confirms this elevated volatility expectation with elevated implied volatility for the October 28th contracts. The market is poised, waiting for the signal from CEO Anthony Noto.
the deeper reality remains that the company is effectively building a modern financial infrastructure, far beyond a simple loan book, and this unique positioning is its core value proposition. Before we conclude, I would like to hear from you. Comment below how many shares of SoFi Technologies Inc., NASDAQ SOFI, you currently hold, and whether you are adding, holding, or reducing your position before the October 28th earnings announcement. Your direct action is part of the collective market sentiment we are analyzing. In summary, the expectation for SoFi is a profitable growth stock riding an interest rate tailwind, but the reality is a technology-first, bank-chartered entity rapidly diversifying its revenue stream with high-margin fee-based income, insulating itself from economic cyclicality. The stock is currently priced for perfection, and the next 10 days of trading will be a high-stakes tug-of-war between pre-earnings optimism, likely pushing the stock to challenge the $30 mark, and the fundamental valuation concerns that analysts are still trying to reconcile,